All right, pull up a chair, welcome to the trading floor. Consider this explainer your day one orientation, and well, I'm going to be your senior portfolio manager guiding you through it. You've passed the exams, you've memorized all the formulas, and you are officially a junior financial analyst. But look, out here, knowing how to build a discounted cash flow model is really only half the battle. The other half, the part that actually keeps you employed in this industry, is navigating the absolute ethical minefield you're about to step into.
I want you to internalize this one crucial question. Because honestly, every single trade you execute, every research report you publish, and every client meeting you take, it all comes down to this pivot point. Will you protect our clients' financial security, or are you going to become the market's next cautionary tale? The decisions you make from this day forward carry heavy, real-world consequences. We are way past theory now.
Okay, Section 1, welcome to the firm. Time for a reality check. Because good intentions, they simply aren't enough to survive on this desk. There's a common saying in this industry, without professional standards, financial markets become unstable. And trust me, those aren't just empty words cooked up for an HR handbook. The CFA Institute's standards of professional conduct are literally the glue holding the entire global financial system together. They protect investors, they maintain market integrity, and they promote professionalism. If we, as a collective industry, just decide to stop following these rules, the whole market fundamentally breaks down.
Now, a lot of rookies tend to confuse a code of ethics with professional standards. Your code of ethics is essentially your moral foundation, the broad, general guidance about what values to follow, kind of like a compass. But professional standards, those are your detailed rules of the road. They dictate the specific, practical application of those morals in real messy situations, right here on the trading floor. We don't survive on broad principles, we survive by executing highly specific conduct requirements.
Which brings us to your very first absolute rule. Standard IA, knowledge of the law. Yes, you have a mandate to understand all applicable laws, but here is the absolutely critical part. You must always comply with the stricter rule. If you're ever stationed in a country where, say, the local insider trading laws are super weak, but the CFA standards prohibit the action, you follow the CFA standards. Period. No exceptions. You always default to the higher ethical standard.
All right, Section 2, the insider trading trap. This is Standard 2A, and we really need to talk about it because it is the absolute fastest way to end your career. It's wildly tempting and incredibly dangerous.
First, let's make sure we clearly define exactly what we're talking about here. Material, non-public information. This is confidential data that would significantly impact a company's stock price if the general public knew about it. Let me be perfectly clear on this. There is absolutely zero gray area. You are strictly prohibited from using this information for personal gain, no matter how much of a sure thing you think it might be.
Let's look at exactly how this trap is built using a real-world scenario. Step 1. An employee confidentially learns that Reliance Industries is going to announce a massive acquisition tomorrow. Step 2. They think they've got an edge, right? So they quietly buy shares before the public release of the news. And step 3, boom, the trap snaps shut. They just traded on material, non-public information. They've instantly created an unfair market and completely destroyed client trust.
And that brilliantly illustrates exactly why regulators police this so heavily. Markets become inherently unfair when a select few investors receive secret advantages. It completely undermines the entire integrity of the capital markets. Think about it. If the public believes the game is rigged, they stop investing. And if they stop investing, well, our entire industry evaporates. We'd literally all be out of a job overnight.
Moving on to Section 3, navigating conflicts of interest. These are standards I, B, and VI. As a junior analyst, outside parties are going to constantly test your independence and your objectivity. And it won't always be obvious. It's usually going to be incredibly subtle.
Let's contrast the right and wrong choices here. Say a brokerage firm starts offering you perks like luxury vacations or super expensive gifts right before you make a stock recommendation. Accepting those is a severe violation because your judgment is now completely biased. The correct ethical action? Politely but firmly refuse those inappropriate gifts. Similarly, if you're recommending a stock, hiding the fact that you personally own a huge position in it creates a massive conflict of interest. The mandatory ethical action there is proper disclosure. Transparency is always your greatest shield.
Okay, let's test your instincts here. Imagine an analyst receives some really expensive gifts from a company's management team just before issuing a highly favorable research report. Which CFA standard is most likely being violated here? Take a second to really think about what's actually being compromised.
Well, if you guessed standard IB, you hit the nail right on the head. Those gifts severely impair your independence and objectivity. The very second you accept that gift, your research report is tainted. Your clients can no longer trust that your recommendation is actually based on solid data analysis. They basically have to assume you were bought.
Section 4, Fiduciary Duty in Clients, Standards 3A and 3C. Look, if you forget absolutely everything else I tell you in this explainer today, please remember this. The ultimate rule of this firm is loyalty, prudence, and care toward the client, above all else.
I really need you to drill this definition into your head. Fiduciary duty means you have a strict ethical obligation to prioritize client objectives, their risk tolerance, and their long-term welfare way above your own personal gain or your commissions. If a portfolio manager chooses an investment product just because it pays them the highest commission, rather than getting the best returns for the client, they've massively breached their fiduciary duty. The client's interests are paramount in every single transaction.
Here's a pretty stark example of what a horrific failure in client care actually looks like. Say a retired client comes to you seeking safe, reliable income. If you turn around and advise them to buy highly speculative crypto assets, you have blatantly violated the suitability requirement. Your investment recommendations absolutely must match the client's risk profile, their financial goals, and their investment horizon. Ignoring what they need for some risky play is a fast track to losing your license.
And hey, if you think these localized ethical failures don't have massive, far-reaching consequences, just look back at the global financial crisis. Weak ethics at the institutional level, totally unchecked conflicts of interest, and extremely poor risk disclosure, they all contributed significantly to a devastating global market collapse. Millions of people lost their life savings, their homes, everything. That is the catastrophic macroeconomic fallout of ignoring fiduciary duties. It's exactly why these professional standards matter so much.
All right, Section 5, your ethical decision framework. Think of this as your survival guide. The trading floor is an incredibly high-pressure environment, and situations are absolutely going to get murky. But I'm equipping you with a tactical toolkit to handle it. Whenever you're faced with a questionable scenario, I want you to run it through this 4-step framework. Step 1, identify. What ethical issue actually exists here? Step 2, analyze. Which specific professional standard applies to this situation? Step 3, evaluate. Who might be harmed if I make the wrong choice? The client, the employer, the broader market? And finally, Step 4, decide. What is the correct, professional, and ethical action to take? Using this framework keeps your emotions out of it and grounds you firmly in the rules.
So, the crucial point here is to avoid the traps that snare so many other junior analysts. Here are the most common mistakes people make. They confuse strict legality with true ethics. Actually, a better way to put it is, just because it's legal doesn't mean it's ethical. They also constantly overlook mandatory disclosure requirements. They misunderstand client suitability profiles, kind of like the retiree in our crypto example earlier, and they completely ignore underlying conflict of interest issues. You've got to pay close attention to the small details, because in ethics, wording matters greatly.
I'm going to leave you with a massive pro tip from my years on the desk. Simple, honest disclosure often solves a huge portion of your conflicts. When in doubt, just shine a light on it. Disclose your ownership interests, your compensation arrangements, and your personal biases to both your employer and your clients. Total transparency basically eliminates the shadows where unethical behavior thrives. We've covered a ton of ground in this explainer today, from the dangers of insider trading to the absolute necessity of fiduciary duty. So, as you log into your terminal and really start your career today, I want you to take this final question and mentally tape it to your monitor. Before you execute a single trade, before you publish any report, and before you advise a client, ask yourself, is client interest truly being protected? If you can consistently answer yes to that question, you're going to have a long, incredibly successful career here. All right, let's get to work.